Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back, everyone, to another edition of All Things Financial. What we're talking about this time of year are taxes, because we have a brand new tax law that's affecting everyone individually, and I went over that in the last show. But also it's affecting people in business, whether self-employed individuals or corporations or Subchapter S corporations, LLCs, and partnerships. So I wanted to take today and go through some of the interesting changes, beneficial changes, and maybe even some of the takeaways where we used to have better opportunities to save taxes on the old law as a business. But I'm telling you, some of these new changes are major, and they're really good if you know how to apply them to your own business. So let me start off with the corporations. It's been widely held for all small businesses, the accountants, the CPAs, the attorneys, that our general, and the financial planners, our general advice has usually been Subchapter S corporations, when you're choosing an entity or partnerships or individual, or C corporations were the main choice. And then it came maybe much more frequently, the LLCs, limited liability corporation, has become popular over the last 10 to 15 years. One of the major, I think, flexibilities with the LLC is we're able to choose, when we form an LLC, whether to be taxed as a C corporation, S corporation, partnership, individual, or non-designated entity, which is actually just an individual by the IRS code. And that's the default, by the way. So if you, when you form a company, don't choose anything, that's where you're going to be, basically taxed as an individual. But it matters now under this new tax law. It mattered under the old one, but in the new one, here's where we are. Corporate tax rates on the new tax law, Tax Cuts and Jobs Act of 2017, the maximum rate of 35% for C corporations has dropped, and there's a new flat tax rate of 21% for C corporations. That's thrown the world upside down on accounting for all businesses, because we're getting a lot of questions and a lot of requests now. I'm a financial planner, not an attorney. So if someone says, Jack, should I change my entity from a Subchapter S corporation to a C corporation? Or my LLC taxed as a Subchapter S to being taxed as a C corporation? I have to defer that to the attorneys and say, I'm not an attorney, I can't give advice on that. But what we can do is illuminate some of the tax benefits now that used to be a Subchapter S that was favored. Really now is a C corporation that's favored, because it's a flat tax rate of 21%. So we see a lot of people saying, wait a minute, I might want to convert from a Subchapter S to a C corporation. So the first thing I want to offer before we start, the IRS has a publication that it has put out, and I offered one on the other show that I did on individual income taxes. But this one is Tax Reform, What's New for Your Business by the IRS. Anyone who would like a copy of this, contact me, and I'll get one out to you free of charge. It helps go over some of these differences, some of the changes in the new tax law to help you prepare your taxes this year and help you tax plan through 2019 and beyond with some of these new opportunities. So here's the caveat with this C corporation. If you're a Subchapter S corporation now, you look at your tax and it's a flow-through tax rate, which means you take all the profits, all the gross income, all the expenses on your Schedule C, and then the net result is either a profit or a loss, typically, and that profit or loss flows through onto your personal income tax return. So the benefit of the Subchapter S is the corporation limited liability type of benefits that the attorneys tell us. But the other benefit was you're not subject to double taxation. What is double taxation? That's what happens in a C corporation. The C corporation is its own entity filing on its own tax return, on its own employer identification number, separate from your Social Security number, of course, but it files its own tax return. And then any money, profits or losses, stay inside that business. If you, as a business owner, then want to take the profits out of the business as a C corporation already has to pay tax on that profit. Last year might have been up to a maximum of 35%. This year's down to a flat rate of 21%. So yippee for that, especially for those of you who are already C corporations. This is very good news. But on an S corporation, we didn't have to pay tax at the corporate level. We just floated through onto our personal income tax return. So Subchapter S profit, we would just take as additional income. A loss, we would take and offset our personal income from maybe our spouse's job or our other income. Those losses from the Subchapter S would help offset those other incomes. Not so for a C corporation. C corporation pays taxes on its own gains or losses at its own tax rate, which typically was higher than individual tax rates on the same amount of income. So it was always a drawback. And then if you wanted to take money out, you had to take it out of the company and pay tax on it again on an individual basis on your own personal income tax return. So for all business owners, they were typically avoiding the C corporation method because of that double taxation. You're paying tax twice on those profits, that same income, just to take it. Well, now, flat tax rate of 21% kind of changes the game. You still have double taxation, but a much lower income tax rate. So everybody's looking at this now. Should I be a Subchapter S? Should I be a C Corp? Should I be an LLC taxed as a Subchapter S or a C Corp? And today I'm going to go through some of those issues with you. But just as basics, the C Corp has more advantages than it used to. Most times, have your accountant prepare taxes based on if you were a C corporation last year for 2018 versus if you were an S Corp for 2018. I think you'll be surprised, even with that low tax rate for the C corporation, that 21% flat rate, I think you'll be surprised to see that double taxation possibly negates that benefit, and you're still possibly better off with that S Corp. Take it to your CPAs, take it to your attorneys. I'll be glad to help with any input also, and it's a new evaluation to make sure you're keeping the most of what you make. All right, now, another change in the new tax law, the corporate alternative minimum tax. You know, a lot of people aren't aware of that because you don't fall subject to the corporate alternative minimum tax. But the Tax Cut and Jobs Act of 2017, the new tax law, repeals the corporate AMT, which is the alternative minimum tax. That's good news. Now, we get to the other major benefit in this new tax law for businesses. Some of you are aware of it, some of you aren't, and it's called the Qualified Business Income Deduction. It's referred in almost all the journals as Section 199A deductions. It's qualified business income. Here's what it means in a nutshell. Whether you qualify or not, which I'll get to in a minute, here's what it can mean. For businesses who qualify, up to 20% of your taxable income doesn't count on your tax return, which means you're only taxed on 80% now of your otherwise taxable income. That's huge. What a great benefit in here. And it's brand new. We see it here and we see it for real estate. So anyone who is owning a house that you inherited, maybe a grandfather's house or a parent's house, and you kept it, you rent it out to others, well, lo and behold, you may qualify for a Section 199A deduction, which means up to 20% of the taxable income, which is really profits, net profits, from either a business or real estate held as a trade or business, not passive, but active real estate. And I'll get into that. You might be able to exempt up to 20% of your income that you'd otherwise pay tax on. So that's a huge tax break. So I want to go into that because it's the biggest one and biggest benefit. We've even seen accountants missing it already this tax year. Because when you go into some of the tax software, TurboTax and all, if you don't know to X the right boxes and you don't know how to qualify for it, you'll miss it. TurboTax won't stop you or catch you on that. So that's why I wanted to bring it out on the show. A lot of sole proprietors, self-employed individuals, partnerships, S Corps, C Corps, you all can qualify if you do it right, but it has to be qualified business income. So here's how it works. Qualified business income includes income from a trade or a business, like I mentioned, but it does not include capital gains, interest, dividend income. So if some of our profits, which would have been otherwise taxable income from a subchapter S, let's say, that is a flow-through entity, which is kind of a requirement for this. This is really technical in its area. I'm going to try to keep it simple. But some of that profit income doesn't count, like capital gains, if that's part of the profits. So you have to be really careful with this. And employee wages don't count either. But here's the thing. It's generally available to all businesses, all business classes, if let's take 2018, for example, since that's the tax return we're doing now. If your taxable income is equal or less than $315,000 for the year, if you file married filing jointly. Again, this is basically for flow-through tax returns that I'm talking about right now. So that's your sub-S or self-employment individual, let's say, flow-through. So you'd look at married filing jointly, and if you have up to $315,000 worth of profits or otherwise taxable income from your trade or business, it's possible 20% of that you don't have to count as exempt. But again, you have to know how to file that on your tax return. Or when you plug in your taxable income, TurboTax and some of the software we've found, it doesn't take account for this, and it puts 100% in, so be careful there. Now, deductions for taxpayers above $315,000, especially from $315,000 to $415,000, gets phased out. So be aware of that. When we get to this, though, you're looking at a marvelous opportunity. So any of you businesses who think you might qualify, stop. Get a phone call into your CPAs, or if you're doing it yourself even, on a Schedule C, and you've done it that way every year. This might be the year you want to get it to a CPA and have them do your returns to make sure you're not missing that opportunity, because that's a lot of money. Now, here's another big change this tax year for businesses. It's a Section 179 deduction, which many of you are aware of already. That's the depreciation deduction for equipment, let's say, for example, vehicles that you're allowed to expense or depreciate up front, and they're limited in the amounts that you can take. Well, it's been increased. So what happened now is the Tax Cuts and Jobs Act temporarily, and I mean temporarily up until 2026. So it's just not a forever benefit, but it's pretty good. Allows now up to 100% expensing, which is referred sometimes as bonus depreciation of qualifying property. What's qualifying property? I'll get to somewhat of a list here. Has to be real property. It can't be intangible property like it used to be. We used to be able to do some things there. But pretty much that's a good start. When we think of Section 179 in the past, we've always thought of vehicles and equipment. And that's still a good way to think about that. Now, certain type properties aren't eligible and certain type properties are. But it eliminated things like qualified improvement property. So if you know what that is, if you don't know what that is, you're probably not using it. If you know what that is, you better get checking on that because you're going to lose that as far as a deduction this year. The next one, though, expensing is different than depreciating. And you are allowed to expense business assets, and it's changed. Businesses can immediately expense more of business assets than they used to be able to do so. So when you look at this new tax law, it increased Section 179 depreciation, it increased business expensing of property. So you're going to see some opportunities here to take bigger tax write-offs this year than you were able to before. Let me give you some examples. Depreciation on luxury automobiles is capped, and you have two different ways you can do that. And personal use properties the same way. If you don't claim bonus depreciation, which I just explained, that bonus depreciation Section 179, the maximum depreciation you can take in the first year for private passenger vehicles is $10,000. Second year is $16,000. Third year, $9,600 maximum depreciation. Fourth year, $5,760. $5,760. Why do I go through that list? Because you now have a chance to say, I want to elect bonus depreciation, 100% bonus depreciation. And you're allowed to take it, but up to a maximum for luxury autos. Instead of $10,000 in the first year, you're allowed to go up to $18,000 in the first year, depreciation. And then second, third, and fourth year is still the same. So be aware of that, because it's more money in your pocket the more you're able to depreciate. You're not allowed to do computers anymore. We were before. I don't know why we're not allowed, but they took it away. And for property owners, you see that 27 and a half years depreciation time period for residential. That's still the same. So it's a shame they won't shorten that. That's from the 1986 Tax Act. And boy, we would love to shorten that period, but we can't. Now, net operating loss deductions, I will tell you that changed. So if you have net operating losses in businesses, be careful because they're maximized. I don't want to go into the details, but I want to alert you to that they are capped, and you want to be very careful with that. Now, meals and entertainment. A lot of questions have come to me on what's going on in the meals and entertainment. It has changed. The deduction has reduced, so it's not as rich as it used to be. Meals and entertainment is still deductible up to 50%, 50%. But we used to get meals and entertainment in that. So now it's only meals, not the entertainment. So they've limited that pretty much. There are some exceptions, but for the most part, it's just meals. So if you're doing an entertainment event, entertaining clients, the cost of the entertainment, you're going to want to be careful, because if you separate out the bill for the meals, you'll still be able to deduct up to 50% of it if it's purchased separately from the entertainment. So those are big issues there. Now, when we get into the businesses, let me go into this just a little bit further. There's Section 1031 exchanges. Most of you aren't aware of those, but that's real property. If you sell real property, including real estate. Real property means physical property, including real estate. There might be huge capital gains issues. And so what some investors have learned, real estate investors have learned, if you take the profits within a specified period of time and do a like-kind exchange of those profits into another like-kind property, you can potentially defer paying any tax on those capital gains. It's like a rollover of the capital gains into the new property and then go forever and ever into that new property that you're in because you rolled those gains into another like-kind exchange. That's a Section 1031 exchange. We're still able to do that, but not for personal or intangible property, just for major real estate. So know about that. It's still good for the real estate rules. Now, employers, careful here. I don't see this written about much. You're going to want to be careful a couple things here. On fringe benefits, paying for fringe benefits, the new law disallows employer deductions for activities for employees for entertainment, recreation, membership dues for clubs or business, pleasure, social purposes, or if any expenses for a facility used in connection with entertainment or recreation for the employees. So now we have to be super careful. Remember, we all wanted to go to work for Google because they have all these entertainment and things like gyms and all that. We have to be real careful as employers now how much expense we allot to employees because some of that we're not able to deduct. It also, the new law disallows deductions for expenses associated with transportation fringe benefits or expenses incurred for commuting. So if we're helping offset employee commuting expenses, now some of that's not deductible. And finally, under the new law, there's a prohibition on cash or gift cards or other non-tangible personal property as employee achievement awards. So those were all deductible before. They're not deductible now. So I thought I better point that out because it's not being talked about very much. And you'll go along 2019 thinking everything's still deductible as in prior years, especially for those of you doing your own taxes. Be aware of those new limitations. Another one that's been lost, moving expenses. It's been suspended for most taxpayers. Standard mileage rate has been changed. So a lot of business, especially self-employed businesses, take that standard mileage rate, and the law suspends all miscellaneous itemized deductions that were subject to the 2% of adjusted gross income floor. Well, that's where that fell on the old return, on your individual return. So careful here. We may not get any more mileage deductions because of the tax law changes. So be careful when you're doing your personal returns and you're trying to take mileage and wondering why you can't fit it in anywhere. It's because we lost it. So I did want to go through that with you and just kind of go through some of those changes. Now, another one I want to really highlight is back to that section 199A. I want all your business owners to realize you can exempt up to 20% of your income if it's done right. Every business. But not every business qualifies. So there are exceptions. And there are rules, first off, and there are exceptions. It's wage-based. You have to be certain types of businesses. So it's going to take some studying to figure it out. But there's a provision in the code that says a specified service, trade, or business has unique limitations and isn't qualified to be able to do this as much as it wants, like a manufacturing business might not have these problems. So I want to go through this exception. If you're in one of these exceptional business classes, you may not qualify and be able to exempt 20% of your income. Here are the classes. If you're in any of the services or trades or businesses in the services in the fields of health, these are big. Health, law, accounting, actuarial services, performing arts, consulting, athletics, financial services, brokerage services, or any other trade or business that relies on the reputation or skill of one or more of its employees is generally not eligible for that qualified business income or that Section 199A 20% exemption. But then there are exceptions to the exceptions. One of them again is if your taxable income or profits is $315,000 or less, even if you're in one of these specified service, trade, or business exceptions, which you're not allowed to qualify for, if your profits are under $315,000, that is still going to probably qualify you for that 20% deduction. So that's huge. In 2019, that amount goes up. So it's from $315,000 for income to $321,400. So it keeps going up and up and up and up. What this means is tax planning opportunities, tax strategies now available for business owners. First, you have to categorize what classification of business am I in, and do I even qualify? And secondly, do I meet the exception where even if I'm in the wrong type of business, so to speak, that I can still get 20% of my income exempt from paying tax? It's big enough to research. All right, now you real estate investors. And again, it can be only one house, it can be multiple houses. If you have them, it depends on how they're titled, how they're owned, and how you're taxed. Whether you might qualify for this same Section 199A, which means that, you know how we all, as real estate investors, are trying to generate losses to flow through onto your personal returns to offset your other income. Well, you have to be, don't forget, you have to be acting in a trade or business, typically defined as a Section 162 trade or business. And as long as you meet that test, you typically are able to then deduct losses. But that's a tough test. It's like doing over at least 250 hours a year in your real estate activity. I mean, they're tough tests, and you need to look them up if you're going to deduct losses. Well, now we have to pay attention because we might try to exempt 20% of our gains or profits. So now that same test is going to come back. Maybe haunt us, maybe not, I don't know. But that's one of them. That Section 162 is a test. Is it a trade or business, or is it a passive activity and we can't deduct our losses against our other income? That's the big issue in the real estate. So the new Tax Cuts and Jobs Act provided a safe harbor where if you don't want to meet that test, maybe you'll meet this test and qualify for the safe harbor. So I'll just summarize it for you because we're running out of time, but for you real estate investors, you will care about this. The individual or pass-through entity are the only ones that this applies to. And the ones relying on this safe harbor have to hold the interest, which is the property, or the corporation, or however you're formed, directly or through a disregarded entity, which is that IRS default on an LLC. If you don't do anything, you're considered a disregarded entity, which is basically an individual. But you know what that means? That means you can only use the safe harbor if you hold the property personally or as an LLC treated as a disregarded entity, which is basically individually. Well, there goes all the LLCs as S-corps. They don't qualify. So now we have to relook at the formation of the business and is it even worthwhile how you're doing it, or do you need to change and all that. But here's how the safe harbor is defined for those of you who qualify. You have to have separate accounting of expenses. You have to have 250 or more hours of rental services performed. That test isn't quite as hard as it sounds like, but it's pretty hard. But if they allow you to count outsourced contractors and 1099 employees and things like that. So you might actually qualify when it's not your own individual personal hours. It might still qualify. But you have to have contemporaneous records. You have to have time logs documenting all your hours, dates services were performed, and all of that. If you don't, you're probably not going to qualify, even if you do the activities but don't have the records. But advertising, renting, leasing, verifying information from tenants, all that counts. Collection of rents, management of the properties, all of this purchasing of materials. So don't think you don't qualify just because that test sounds so high. You may be able to exempt 25% of your profits on your rental real estate. What doesn't qualify? Travel, financing activities, investment management activities, things like that. So we're out of time. I know it was a technical show. For those of you who are in business, I know you'll welcome that technical side. For those of you who are in smaller businesses, take the high points I mentioned. There are deductions up to 20% of your profits. Make sure you're eligible for them. And for real estate, see if you can get yourself qualified for them. It can save you 20% of your taxes. All right, folks, I appreciate you tuning in to another edition of All Things Financial. I'll be back again next week.